Well, certainly a dovish tone, although also a tone that grants the uncertainty of trying to handicap how inflation goes from here. And the way to interpret, one way to interpret what's happening with bonds is to assume that there's at least a rising probability that the Fed will be forced to move to restrain inflation before they fully want to or have anticipated they're going to be able to. That would bring down longer-term yields. Who knows if that's really all that's happening here. But I do think the general sense of we're not going to know particularly soon whether we're clear of either the inflation threat or the slowdown move that we've seen in the global economy, or perceived slowdown move. I think all that stuff's in the mix. But also, up 17% at the highs in the S&P 500 year to date, the second longest stretch of a decade without a 5% pullback, coming into a rougher seasonal period. And also you have the typical earnings season give and take, sell the news type reflex. I think all that was loaded onto the market this week. It's pretty modest index level move, but definitely more damage under the surface.
Steve, I wanted to ask you about volumes. I noticed earlier today that it was below average volumes, below 30-day average volumes. So not a ton of conviction in the selling. Did that pick up around the close? And does it have to do with some of the mini expirations we saw? Is there anything to read into that?
Well, Sarah, I think the thing with volume that we've been seeing is, quite frankly, other people have found other things to do with their money. They're not sitting at home day trading. They're going to work. They're going on vacation. It is typically a slower season anyway. I think the fact that we didn't have very good volume on a monthly expiration kind of tells you that the lack of interest that one might expect to see this summer. Volume trends have been coming down, but individual and institutional investors remain engaged. But I think they're a bit distracted by summer. It happens.
Anastasia, in terms of the recent pullback that we've seen in yields despite significant inflation data, does that make you enticed to buy gold and assets like that or not?
No, not quite, but it does get me enticed to buy real estate. If you actually, let's talk about some strength that we've seen last week, and it's been in the real estate sector. I mean, at least the REITs are up on the week. And I think this is happening because there's several catalysts that are really helpful to the sector right now. First of all, rates clearly backing off and falling. That's supportive for valuations. But I think more fundamentally, we may see used car prices come down, gasoline prices come down. But where I think we are going to have more sustained inflation above 2% is in the real estate sector, because vacancies are falling, occupancies are rising, renting activity is picking up. And so some of these real estate companies are able to return back to net operating income growth. And also, by the way, inflation means higher replacement costs to rebuild a building. And therefore, you could actually expect some capital appreciation potential from that as well. So I may for now shy away from gold, but I would be looking at the real estate sector very closely.
Steve, to what extent is the Delta variant driving the conversation for investors? Because if you look at lower treasury yields and a stronger dollar and weaker stocks this week, you might think there's some concern building about what that's going to do to the outlook, because these cases are rising significantly in the United States. Is that a factor? Is that a worry given where we are in the pandemic?
I think it sort of should be if it's not overt. I think it is out there, and I think that's kind of what's contributing to the fact that we're seeing lower long-term rates, because I think people might be fearing that there's some sort of fear trade in there because of a slower economy. Hey, I was on my way to the Yankee game last night and had to turn around because of the COVID outbreak, and I didn't hit the sell button as soon as I walked back in the house. But I kind of had the sense that today was going to be under a bit of pressure as the more that COVID gets back in the conversation, and we saw it last week when the Tokyo Olympics announced that there would be no spectators. It's when it's obvious to regular people, when it's sort of in your face, it does get back to being a factor. Although I think I think the market's kind of sanguine, thinking that we're never going to go back into the kind of lockdowns that we saw before, but it can still be a drag.
Mike, VIX jumped relatively significantly today, though I guess still well below that 20 mark that we sat above for so long.
Right. And so there's clearly been a bit of a hedging instinct out there in the markets. I know Steve does a lot of work on this, but essentially there's been a real bid in people trying to protect themselves against a relatively severe downside move, most likely because they own stocks, not because they want to get outright short. And so that's probably why the market's a little bit twitchy. You're kind of threatening, multi-week lows at the angle of the sell-off we had this afternoon. So it's popped up. It's not really giving you a real stress signal out there or something where people feel like they're completely caught offside. And in fact, if you look at the way the VIX futures are set up, it's still okay in terms of being a normal setup. But it does show you that, as I said, everyone knows starting in mid-July, things maybe get a little bit dicey by history. So it seems like a little bit of a buildup of caution, if nothing else.
Shepard Smith here. Thanks for watching CNBC on YouTube.